We'll start off the discussion uh, by knowing more about first source initiatives to reimagine the future of the BPO industry and open the session for Q&A. We would be recording the initial part of the discussion until the beginning of Q&A. With that, let's just kick off the discussion. Uh, Ritesh, I'll just start off with the first question on Gen AI, of course, which has been kind of a catalyst for the entire BPO industry in terms of the change which you're also seeing, uh, which is basically reshaping the entire services industry alike, with some deflation likely in the traditional business. Just wanted to get your point of view on this.
Well, thank you, Vamsi. And that, in some sense, is almost like the elephant in the room with everything playing out on the AI front. But I'll take this one level higher. Um, there are three broad shifts that are today hitting us concurrently in the marketplace. Technology being one of them. But if you just take the macro and everything that's happening on the geopolitical side, the fact that you end up having uh, nationalistic policies that are out there, whether it's America first, where a lot of Western economies adopting that kind of a scenario, or you see the trade and tariff imbalances that exist, a bunch of conflicts that are playing out. I don't know if you're aware, but there are about 72 geopolitical conflicts that are out there. We know the more popular ones or the more common ones, but there are several more that are simmering out there. Um, then you also have the fact that for the first time, we actually have multiple generations of folks in the workforce. So the anthropological shift is huge. And the fact that you have people with differing needs and demands and expectations in the workplace creates its own uh, set of challenges as well. And last but not the least is, I think, the technological shift itself. I think November 29th, 2022, when OpenAI launched ChatGPT, will continue to remain a seminal date because I think it changed the landscape forever. However, if you look at even the technology side, right, going back from November 29, 2022 to where we are today, that date already seems like a moment in AI history, just given the pace of change that's playing out, right? So the fact that you're having all these three shifts happening concurrently um, creates almost a seismic shift for an industry that's used to operating in a certain way. And by the way, this in my mind applies not just to the IT services or the BPO industry, but I think it applies to every industry sector itself. We are in a classic innovator's dilemma moment. And if you look at what Clayton Christensen, who had coined the term the innovator's dilemma, had talked about, every time you're confronted with it, uh, scale and incumbency become limitations. Large companies tend to struggle to adapt, they tend to be slower to respond. And the very things that made them successful could almost end up being disadvantages. Now, I'm a student of history, so when I was looking at all these shifts playing out, and in fact, that was one of the things that prompted me to come on board and join First Source. The one thing that was very clear to me was that the traditional approach of labor arbitrage, which had been the cornerstone on which the entire IT services and BPO industry had spawned itself over the last 25 years, was dead. Uh, let me explain why. Right, the labor arbitrage era company was founded on headcount scale. It was founded on process. It was founded on predictability. It was founded on standard services. And if you look at what played out 25 years ago, there was traditional outsourcing that were there, but the companies that failed to make the pivot towards offshoring, towards lower cost locations, actually were the ones that got decimated. I mean, how many of us remember companies like EDS and CSC and ATOS and CGI? It's not that these companies are dead, but they're a pale reflection of their former selves. So it's been death by a thousand cuts. And I think we are firmly now in the era of the tech arbitrage era company itself. And that's what caused us to say, look, the rules for playing in the technology arbitrage era are fundamentally different than what they were in the labor arbitrage era itself. A, in the labor arbitrage era, it was all about cost. There were very clear boundaries that were laid out. labor arbitrage was the key asset. In fact, I go one step further to say people, if you look at a lot of companies, they would put out on their website, I'm in 50 countries, 100 locations, and location dispersion was a competitive advantage. However, in the tech arbitrage era, if you if you can actually deliver, let's say, German speaking skills sitting out in Hyderabad by a person who doesn't speak a word of German, using real time language translation with minimal latency, location dispersion now suddenly becomes location debt. Add that to one more debt that organizations are saddled with, right? Hierarchical organizations, which has been a relic of not just the labor arbitrage era, but going way beyond that to the industrial revolution, is perhaps also going to be under a significant amount of stress. I'm not for one saying that hierarchy has no role. However, to be successful in the tech arbitrage era, one needs to have a distributed structure, one needs to have networked organizations, and you need to get to an environment where it's hyperscaling itself. And then finally, in the labor arbitrage era, a lot of it was build internally as opposed to leveraging partners. And I think in the tech arbitrage era, to move at speed, to be able to capitalize on everything that's happening out there in the marketplace itself, fast experimentation, failing fast, and leveraging the partner ecosystem become critical. And last but not the least, if you look at the labor arbitrage era companies, it was all, pardon my French, put a bum on a seat, you get revenue. A very linear revenue model itself, right? And in fact, everybody in the analyst community would look at headcount growth as a lead indicator of how a company is doing from a growth prospect standpoint. In the technology arbitrage era, enterprises are holding service providers more and more accountable towards non-linear commercial outcomes. And by the way, this is putting stress not just on services companies. Services companies had labor as the primary variable on which they stood on. But if you look at SaaS businesses as well, they're under the same stress because they sold based on a per seat, per user basis without an accountability for outcomes. And they're facing the same amount of stress today. So these models are starting to converge. We are in a services as a software environment. The technology arbitrage era company is going to have fundamentally different attributes compared to the labor arbitrage company. And that's what I think we're trying to build within First Source today.
Perfect. Okay.
I just add one more point. What it also does is, given the fact that the boundaries between IT, BPO, operations, all of these are starting to diminish. I won't say disappear completely, but they're starting to blur. What this also starts opening up is a much larger addressable market for players like us compared to what we saw in the past. And I think that's something that keeps us excited because I think we can now start playing in spaces that we didn't play in the past as well.
Honest. So it, yeah. So the idea definitely is something which is different from the market, maybe the need of the times. So just wanted to dial upon each of these tenets of this framework, maybe just starting with the commercial constructs of these engagements. So how does one or how First Source, how are you reimagining the commercial constructs? What does this really entail? And then how are you really factoring in the use of tech and platforms as well as some of the non-linear elements into these contracts?
So, one of the things that, let me just take a step back before I respond to this, right? The ability to often underwrite business outcomes and give a nonlinear commercial construct is predicated on a few different variables. And I think that's the other piece that I think is going to be successful for companies in the tech arbitrage era, right? Depth and domain. Uh, pick your verticals and be very clear and deep in those. Number two, technology contextualized to the domain. It's the ability to have both of these that give you the comfort and confidence to actually underwrite the outcomes itself, and then the requirement to move at scale. I think these are the four attributes that are, I think, going to be success factors for companies in the tech arbitrage era. Now, if I use that as the preamble, I want to give you three examples in three different industries of nonlinear commercial constructs. Right. So let's start with an example in the financial services space. We do a lot of work with with banks as well as fintechs. And some of that work is centered around their collections itself, or whether it's their credit card debt, whether it's their other unsecured loans, the BNPL portfolio, etc. And one of the things that we've been able to do is to link our fees to the amount of debt that's collected. And the only way we are able to do that is by having a degree of comfort and confidence on the amount that we're actually able to collect. And that comes from years of experience in the domain. But more lately, in the last few years, we've been able to infuse AI and ML into our digital collections platform itself. And what that allows us to do is to uh, hyper personalize and collect at scale at an individual level. So, for instance, if I had, let's say, $4,000 of credit card debt, the ability for a credit card collector to reach me at a time which is when I'm likely to respond at a medium of communication which I'm more responsive to. Let's say WhatsApp is my preferred medium of communication, or reach me at a frequency at which they know I'm likely to be more receptive to it, improves propensity to pay. The ability to have a handle on all of these attributes improves your uptick. And by improving your uptick, what it also allows you to do is to increase the amount of money that you're able to collect and therefore underwrite the outcome successfully. And this is just one example of something that we do in the financial services space. I'll take you to another example in a different industry, which is in the healthcare side. So we do a lot of work in the healthcare payer side of the house as well as on the provider side, but I'm going to give you one example on the payer side of the portfolio. Um, and this is an example where if you look at the variable that payers are most concerned about, especially in the current environment with operational costs having crept up meaningfully, they want to reduce their per member per month cost, their PMPM cost, as it's called in the industry nomenclature itself. And anything that they can do to reduce the PMPM cost is meaningful because it improves their operating margins. And that is critical in the context of two variables that health plans monitor, which is the administrative loss ratio and the medical loss ratio. These are the two things that they typically keep track of, every health plan keeps track of. Now, there are a bunch of ways by which you can manage and improve or lower the PMPM for health plans itself. And one of the things that we've been able to do out here in one of the deals, but also in several of the deals, is to uh, bring a consortium of partners. We might end up replacing the core administrative platform that the health plan might have. We would bring in some tech interventions on the automation side of the house. We would try and run the operations in a post automation integrated world itself. But the net effect of it is what we're able to commit to customers is we can move you from point A to point B, let's say over a 3 to 5 year time horizon, and reduce your PMPM cost. Now that's something that's very appealing to health plans, because what they have comfort on is the fact that we are underwriting the risk, or rather the transference of risk has happened to First Source as a service provider. And the net effect of it is, from their standpoint, their cash flows and their outflows are known itself. So that's a second example of something that's very prevalent and certainly very popular in the healthcare payer line of the world itself. I want to give you a third quick example, which is on the telco side. Now, this is a very crowded market, and everybody has outsourced for the longest time. But if you go back to a pain point that most telco service providers and cable operators are saddled with, it's increasing truck rolls. And truck rolls is the biggest part of their cost structure. Anything you can do to reduce their truck rolls as a part of their overall cost structure is money in the bank for them, because their costs are already a sunk cost. So anything that you can improve that is margin. So if you can link your commercial fees to, let's say, reducing truck rolls itself, that goes a long way. So again, we've been able to construct commercial deals with telco carriers centered around reducing their truck rolls. So these are three, I wanted to give you three very different kinds of examples to showcase the usage of non-commercial, non-linear commercial constructs itself in today's world.
Yeah, and that really covers the key verticals that you have, and that's quite helpful. And just to dial it a bit deeper, so since you have joined, one point to emphasis was to improve your GTM presence with addition of 40% higher headcount in the sales team. Now, this sales team obviously needs to be reoriented from the older ways of selling to a NBPO framework and within the tenets of the NBPO framework. So, how are you really reorienting this team and keeping uh, uh, them motivated?
So let's take a step back as to why did we go ahead and first even ramp up and then talk about what are we doing with the team that is on the ground, right? Uh, when I joined in September of 2023, almost going 2 years back, at that point in time, one of the first things that I discovered, and this was actually part of my thesis to the board when I was interviewing for the role, was Firstsource had a great portfolio of clients. However, it was underpenetrated in those accounts itself. In fact, when I was doing my secondary research, I would have given my left arm and right leg to have those logos. So the hard work of actually having MSAs was there. These relationships were long standing. Um, they the very fact that they were continuing to be there for periods in time suggested that we were delivering value. So cross sell, upsell was a key part of what seemed to emerge as a theme that we needed to focus on. So one of the first things that I ended up doing very quickly was to say, let's identify within our existing portfolio the accounts that could probably give us the biggest bang for the buck in terms of growth itself. And we identified at that point in time what we called as a cohort of 50 accounts, FSL 50, and we said these are the accounts where we need to double dive on. And we said for these accounts, let's make sure we have a client partner whose life it is to walk the corridors and make sure that we're able to cross sell and upsell our existing offerings itself. Number two, let's make sure that there is a process in place to there is an account plan so we know exactly who are we going to meet, when are we going to meet, what are the outcomes, and a lot of this is more science than art. I mean, this is all block and tackle stuff, nothing which is like really cool and sexy, but this needs to be done. And number three is, let's make sure that there is a process where there is a regular review and governance. For instance, I get a report every fortnight from the client partners on the progress in each of these now not 50 accounts, almost 100 accounts in our portfolio that are what we call as strategic logos itself. And these accounts have significant headroom for growth, right? And the benefit of that is that we've seen obviously a significant uptick in the metrics itself as an outcome of those investments coming in. But also the other thing that we did along with it is to put a clear delineation between people who are uh, focused on expanding our footprint in existing accounts, but also people who are looking to land new logos. So, as an example, last quarter we added about 70 new logos, which is the highest that we added in the last 3 years. And a lot of it uh, came often at the expense of large incumbents, some of our larger peers. 80% of our new logo wins were against larger peers. And some of that we feel is because of what we're able to take in terms of solutioning. So what are some of the things that we're able to push with our go-to-market teams? Number one, proactive solutioning. We're able to shape deals proactively with customers. We're not waiting for an RFP. So the ability to keep taking ideas to them is where the secret sauce is, and in some sense, to try and tell them where they could look for opportunities and almost in some sense be a trusted advisor to them. Number two, where there might be standard RFPs as well, if a customer is, let's say, asking for a time and material kind of a rate card, can you push an art of the possible proposal, which is a non-linear commercial construct? And we're trying to make sure that that's something that we're institutionalizing across all our responses itself. I think by doing some of those pieces consistently, what we're able to do is improve our win rates. We don't win everything, but certainly we end up having a fairly good shot at being able to shape deals and build that trusted advisor status with our customers itself.
Yes, that's that clear. Um, this is what you have said until now. I mean, there has been a shift in the commercial constructs, which might also involve some change in the way of delivering the work to the clients. So just a couple of questions here. First, is the current existing org structure an optimal one to realize the full potential of this? And second is, how do you really envision the delivery of platforms and tech partnerships to evolve over the medium term?
Yeah, so I kind of referenced this in my opening comment, and to your first question itself. Our view is that the traditional pyramid model that existed in the labor arbitrage era is soon, past its sell by date, and we will move towards org structures which will be very different in design and outlook itself to serve what the tech arbitrage era company needs to look like, right? But let me take a step back, right? The future of work is still evolving. We frame it as a three-pronged question: who does the work? And it's important to think of it in this fashion because, uh, from a first principle standpoint, who does the work matters, because the work could be done by a full-time employee, it could be done by a gig worker, it could be done by an AI agent. And all of these three have different archetypes in terms of what they bring to the table. How does work get done is a task allocation question, which is how do you distribute work amongst these different personas? And then finally, what skills do people need to bring, or what skills do each of these archetypes need to have to be successful in what they're assigned? Right. So if you think of it as a who, what, how question, then you start saying what do the organization structures of the future need to look like itself, right? Now, one of the things that we've been spending a lot of time on, in our existing body of work that we do with our customers, is to say, let's look at the entire workflow orchestration, which is break the process into a series of atomic level tasks. Unless you're able to break an existing process that you support into atomic level tasks, it is very hard to identify which of those tasks can be done by which archetype of whether it's a full-time employee or gig worker or an AI agent. Number two, we are saying the workforce redesign needs to happen for the same processes itself. So you might end up moving from a pyramid model towards a diamond structure or a T-shaped structure, but those are some of the things that we are working on as we speak as well, because we know that that's where the puck is likely to go. The build of the AI agents itself, where appropriate, is probably the more commoditized part of this entire thing, because unless you're bringing the depth and domain and the understanding of the process breakdown into tasks, the AI agent itself will not serve the purpose. But one of the other things that we've also done is built out a crowdsourcing platform. Our view is that today we might need some full-time employees for different kinds of work, but tomorrow some of those tasks could be done by people in the crowd. And if that's the case, you need to be ready for where the puck is likely to go. And last but not the least, this is all humans at work. So change management is very critical. So we are working on these five elements as key components of the future of work enterprise stack itself, right? And that's important for us. But the other piece that's equally important is, I think, the recognition and acknowledgement that we can't do it ourselves, right? I'm sure you saw this MIT study, which actually corroborated what I think we are doing, where they said you're better off buying rather than building. And I think that's one of the philosophies that we've tried to follow. We've said we are tech first, but we're also partner first. We believe partners give us the wherewithal in terms of speed and agility. They give us the ability to try things quickly. And the reason why there is a complementarity out here is because they have the IP, oftentimes to solve complex problems. However, they may not have the distribution access. We have the distribution access, but we may not have the IP at times. But the combination of the two creates a complementarity which we can solve a customer's problem itself, and that's where I think there is value to be had. So I think when we approach it from that vantage point, building those partnerships becomes a very critical success factor itself, and that's one of the things that we've spent a lot of time on. I mean, even today, and I've talked about this publicly, I spend about 8 to 10 hours every week consciously meeting startups, and that's by design, just to ensure that we are hearing of new ways to solve things. Sometimes you may just walk away with no ideas. Sometimes you might get an interesting solution to a problem that you've been looking to solve, and the net of it is a beneficial arrangement for both parties.
Understood. Um, yeah, so maybe just one before we open up for the Q&A session. Um, just to understand what really is posing it, Gen AI. So just wanted to understand where we are in terms of adoption and the use cases, uh, as well as the extent of productivity that can be in real life can be possible in an enterprise tech stack or in enterprise processes. And can you share other areas where customers are facing some difficulties or key impediments why they have been unable to really roll this out. And then second related question is, every disruption also brings about some opportunities. New revenue streams could open up. What in your view could be those which will really pick up as Gen AI will pick up momentum?
Yeah, so I think one of the things that we're trying to do as an organization is to ensure that AI is getting more and more pre-wired into our existing engagements itself. Now, look, we are still in the early stages. I'm not going to say that everything is figured out, etc. And let's take a step back, right? Till 6 months back, agentic AI was not part of our vocabulary. And now we talk about it like it's normal discourse. So, the world is moving at a very fast pace. The key for us is to keep pace with that and adapt our business. So, even with UnBPO, our endeavor is not about the technology as much as it's about how do you build an organization that can navigate through the shifts and thrive through the changes that are there, right? And so, with that in mind, one of the things that we're trying to do uh, is to try and make sure that we are able to shape pursuits with customers where AI is an integral part of the conversation itself. And in some instances, and it may not be, AI may not be the panacea for everything. There are some places where unit economics may justify that what an RPA did may serve the purpose, what a workflow automation did may serve the purpose. And the key here is often being able to act as a trusted advisor to tell the customer that here's where something which is deterministic from an AI perspective serves the need. Here is where something which is more probabilistic is going to be more relevant, right? And being able to guide them in that journey is going to be critical. And I think where we are able to do that, I think we are seeing value and benefits for sure. Um, what I think is often a challenge for organizations is being able to work with them on some of the impediments that can come in, which is the quality of data that they might have in their environment, which may not be completely up to snuff in terms of what's required to make AI relevant and work. Number two, maybe their privacy and security considerations, and that's often something that you might run into in regulated markets itself more so than others. And that can come in the way in terms of whether they can do this or not. And third, it could be just plain simple organization change. I mean, just think about it. If you try and take today, it's not that the technology cannot serve the purpose, but you can almost have two truths that can coexist, right? In a way, the tech is very real, and B, most companies are hilariously bad in deploying it. And both of these can coexist in a way. I mean, you go to a startup, if you're building from scratch, AI can feel like a superpower. If you go to a large enterprise that has been used to working in a certain way with legacy systems, multiple step approval processes, a team, asking if chat gpt has to be soc 2 certified, that's what is the reality in a lot of large enterprises, including fortune 500 companies, right? In that kind of an environment, getting AI through requires a lot of hurdles before you're actually able to deploy it at scale. And that's why you run into a bunch of proof of concepts and proof of values that you're working on. But from my vantage point, again, I go back to this entire thing of history rhymes itself. This is no different than how it was when cloud was coming into play in the 2010s, when mobile played out before that. Each of these revolutions comes through a certain phase where there are a bunch of proof of concepts and so on and so forth before you start getting to the real stuff. So I think we're in year one of probably a decade-long journey in terms of how this is likely to play out. But what I will also say is, what's equally exciting to me, I mean, look, we believe at our size and scale, we're not that small that we don't get a seat at the table, but yet we have critical mass in all our key verticals, so we can punch above our weight. And we're not that large that size becomes an impediment, right? Uh, what it allows us to do is to go out there and proactively shape proposals, automate some of the suggest, cannibalizing some part of our business where it might be relevant, and yet make it both revenue accretive and margin accretive from our vantage point. And that's one of the things that I think we've been successful in doing. The second thing that it's also done is it's expanded the target addressable market as well. I'll give you one example of that, right? Today, one of the fastest growing parts of our portfolio is what we are doing on the AI training data services side. And this is a lot of work that we do for Silicon Valley companies to make their frontier foundational models more robust. And the kinds of work that you're doing out there could range from work that you're doing on the data collection side, which could be either traditional field collection, moderated collection, or synthetic data collection. It could be around uh, what is called as multi-model and multi-modality. So you're working with multiple models that these Silicon Valley companies have, but cutting across text, audio, video, image, different modalities in which various forms of data exist. And last but not the least, looking at coding, which could be centered around model validation, or it could be even around prompt engineering. Today for instance, one of the open source models that we work with, AI generates the code. We have expert code reviewers at our end who are actually reviewing the code, right? Now, this kind of an opportunity did not exist 12, 18 months back. And I think what we are starting to see is it's opened up a completely new TAM, as is the case with any technology shift, for us to start taking advantage of. And that part for the portfolio is growing the fastest for us as well. So we feel good about what we see. As I said earlier, also, scale and incumbency in the tech arbitrage era could potentially end up being limitations, and which is why we feel at our size, we think we can benefit from taking share from the larger players who may be reluctant to cannibalize their business and maybe slower to respond, as well as smaller, undifferentiated players, of which this industry has a long tail, who are everything to everybody and nothing to anybody, and then benefit also from the expanded TAM as well.